Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveney, and today I want to talk about 5 passive investing opportunities in 2025. I can't believe it's already 2025. So I want to talk real estate and the typical markets that people invest in real estate. And my thought process, these are just my own personal opinions. So I'm sure there's going to be people who agree, people who disagree. Just going to want to talk about my opinion on what I believe the investment opportunities are in 2025 through the real estate asset classes, and whether I would kind of give it a thumbs up, thumbs down, or a neutral investment strategy. So with that being said, let's first start with what has been extremely hot earlier this past decade, but has hit some bumps in the road and is an asset class that in 2025, a lot of people are scratching their heads on, do I invest, do I not invest? And that is the asset class of multifamily real estate. And for those that are somewhat newer to real estate, multifamily is apartment buildings, typically more than 4 units. And there's different classes of multifamily. There's Class A, which is the top tier, Class B, and then Class C real estate. And typically, the lower the class, the more volatility within that specific type of investment. For example, Class C multifamily typically has a lower price point, might have higher vacancies, higher loss rent ratios, but also typically is bought at a lower price. So depending on how you manage it, could go really well or could go really upside down. So what does multifamily have going for it in 2025? First, always a stable demand for people in a place to live. We'll talk about commercial office space later. But in multifamily, people need a place to live. There's reports out there about how many housing units we have that we're short. Now, my personal opinion is I kind of don't believe that data. And I think we have an inventory shortage, but I question in regards to a housing shortage. And I also go back to, 2006, 7, and 8, and even before then, in the late 90s. Oh my God, we need to build all this housing. And we start building it in, 04, 05, 06. And what happened in 2008 to 2013, you basically have your pick of the house you wanted. So I don't recall anybody ever saying there was a housing shortage in 2010, 11, 12, and everybody had stopped building at that time. And of course, the number of people in this country continue to grow. So you have that stable demand. A benefit also to multifamily is, it has that tax advantage to it with depreciation. But what does multifamily what's impacting multifamily in 2025? And the, top thing that typically impacts it is interest rates. Multifamily is typically an asset class that is bought with leverage, meaning you get a bank from a loan. So what a lot of, I'll call it syndicators or funds do, is they'll raise 30 to 40% of the money from investors, and they'll borrow the remainder from the bank. And the value of the property is really based off of how much money it's making. And with money making, there's 2 categories: the money coming in and the money going out. The money coming in sometimes can be a little bit easier to predict based off of a stabilized building, meaning that it stays 95% filled. You know what the rents are. Rents might increase slightly or decrease, but there's not a lot of change. So, what comes in typically is, can be determined. What goes out the door has a greater impact because there's a lot of unknowns, miscellaneous repairs, additional repairs, capital expenses, the mortgage payment. They're borrowing that money and the interest rate has that significant factor, as well as the other area that is really having an impact on multifamily is the insurance. Taxes are always going to have impact on a property, but insurance. As I'm recording this, there's, a lot, I feel sorry with what's going on in California with the fires and, the insurance claims and all that is going to also do besides the, exorbitant loss. And again, not downplaying, I can't imagine losing my house to a fire and having to rebuild. And what's, part of this is also going to be unfortunate is it's going to raise rates for a lot of other people elsewhere as well. So it's going to be even more expensive. Well, in 2025, is multifamily going to be good? Not so good? And here's where I think it's going to come into play. I think for those people who are very good operators, they're going to see ample opportunity in the multifamily space to be able to strategically acquire assets that might either be in distress or might be mismanaged. And it's just like any real estate. Residential today, we'll talk about that in another one. But there's not a lot of assets on the market. There's not a lot of trading going on. But the trading that does happen, there could be significant opportunity. For me, as an investor, I'm going to shy away from multifamily this year. I kind of want to see how the dust settles. And that's not because I don't think there's opportunity. I think the opportunity does pose some risk. And I'm at a stage where I'd rather be at the water park on the lazy river, not on the top water slide and the excitement. So for people out there, if you're looking at multifamily deals, take a look at the interest rate. How long is that locked up for? What are the financials? What type of property? How long has it been stabilized? If it's a value add, meaning that the person's going to go in and add value to it, what are they going to add the value? And is the rent they're going to try and get realistic? These are questions you can ask. When they get the information, there's plenty of people out there that could help. That's multifamily. The next one, which I think a lot of people would consider the dumpster fire of real estate right now, commercial office, which is investing in office buildings, shared workspaces, and what's going on with commercial office. Now, I think actually commercial office has the best long-term opportunity right now for large-scale investors because we're seeing a lot of assets trade at historical low prices. When you see a $40 million asset that traded 5 years ago, trading for $5 million, $10 million, somebody holds that for a decade, 15 years, which is typically what you want. Commercial office space isn't something that's traded, not like a merchant multifamily where people might want to build it, turn and flip it. Commercial office, long-term hold. I think there's going to be plenty of opportunity. And while people continue to look at the lack of demand for office, you are seeing more back to work, versus remote. Now, I come from a background of, I worked almost 25 years in an office. And, last several years have been remote. There's pros and cons to both. I actually lean more heavily towards in office, believe it or not. Now, I'd say I lean towards a mix, but, of 3 to 4 days in the office. Now, my company's completely remote. We're not going into an office at this point in time or foreseeable future. But the reason I say this about office and why I think you're going to start seeing some of this office space start to fill up again, probably not this year, but in the future. But this is the year where I think you can get some prime buying. Is as the younger generation goes to get into the workforce, I can't tell you how valuable it is to stand side by side with somebody working on an issue and asking the questions to solve it. And whether it's, think about it this way for people who have kids. You ever had helped a child build Legos? You're sitting there watching, they're watching you and showing you. Imagine trying to do that via Zoom. Think about that for a second. Could it be done? Yeah. But for the younger generation out there who's just getting in the workforce, I would tell you, you want to be in an office and you want to be working next to somebody who is experienced, because it's going to lead to better job growth later on. Now, how does that impact, again, commercial office? Again, it goes back to, if you're an investor and you're looking at a long-term play, not something that is 2-3 years, but a 10 to 15 year investment strategy, I think commercial office is going to be a very good asset class down the road. It's still going to have its bumps this year. It's still going to be rocky because of the loans that are maturing and whether the banks are going to kick the can down the road or push the issue. But because of that, just like, let's go back to 2008 in residential real estate. That was a dumpster fire. People who ended up buying good properties at that time and staying in the game, they're going to reap the benefits and rewards. It's every asset class in real estate. You're going to do well in the long run. So that's my thoughts on commercial. Next, let's talk short-term rental. Probably the one I am the most biased on. I am not a short-term rental fan. I'm just not. I was looking to own one and actually glad I didn't. And even having a management company, it's still part of a business. Here's why I'm pessimistic on short-term rentals. One is, I believe, exclusive of certain areas, they are going to be very challenging to continue to buy them today. Now, if you've owned one for 10 years or 15 years, continue doing it. I'm talking about if I wanted to go invest in short-term rentals today, would I? And the answer is no. Because most of the best short-term rentals, where are they located? In the mountains, happens in the mountains, there's fires, or near the ocean, happens near the oceans, floods, hurricanes. Cost to manage those is a burden. And for example, I'll share a story. Right before COVID, January, February 2020, we had a property under agreement in the Outer Banks. And it was 4,000, 5,000 square foot property. That was a duplex that you could use it as 2 units, 1 unit, in a community, could walk to it was 3 rows back from the water. It was an awesome house. Owned by an LLC, had it under agreement, I think for $530. And, we were going to, go down, use it for a few weeks during summer, as well as, rent both sides. And even renting it at that point in time, basically it would cover the cost. It wasn't a great investment to make money, but it was something long-term that, I wanted to hold on to. It was owned by an LLC and the partners couldn't agree to decide to sell it. COVID hit. We got cold feet and nope, let's just wait, see what happens, because again, goes back to that uncertainty, and I'm not the biggest risk taker. Fast forward to today, I think the house is now worth, they're saying, over $1 million. And in that area, rents have doubled for a week, but I can't see that being sustainable. It's in a great area, but it used to, let's say, be 3, 4, 5,000 a week, 10 to 12,000 a week. I'm sorry, that's not sustainable. And whole regions and areas, especially an area there that could be hurt. I just don't see the sustainability, even though we have inflation and everything else going on. I see people cutting back on things. So I view short-term rentals as buying them today is you missed the boat. Things are too expensive. Share another story about an asset in Gatlinburg that we're looking at the note as non-performing loan. Traded in 2021, I believe, for $900,000. Then a year later, sold for $2.2 million. Neighboring homes are new construction on the market for 1.4 to 1.6. It got foreclosed on, and the lender still thinks it's worth 2.2 because they, have an attachment to the property. And unfortunately, that property's not worth the 2.2. It's probably worth 1.3 to 1.5. What goes up, what comes down. And I think part of it is that area, beautiful area, has gotten overbuilt, and, there's high supply, and the demand is going back to a normal demand. And probably going to see prices start to go back to more historical levels. So short-term rentals, one I am the least positive on. Number 4, let's talk about single-family rentals. This is an interesting one because for the last, 5, 6, 7 years, interest rates were low. So all you kept hearing about was buy for cash flow, cash flow, cash flow. Single family rentals, because interest rates were so low, you could leverage them and easily make money on them. And today, you got that equity buildup. Great. But again, we're talking about buying day. Would you go out in 2025 and buy single family rental property? The answer is, yeah, it depends. But is it a focus that I'm looking on? Not yet. In certain markets, the west coast of Florida, some of the Rust Belt areas, Texas, starting to see prices soften and starting to see inventory pick up a little bit. But interest rates today, which are at historic norms, they're not high for people who've only been in real estate 3, 4, 5 years. I was talking to my wife the other day. Her first townhouse when she moved to the U.S., her rate was 8%. My first house, I remember in 2001, my parents, when we got a rate at 6%, they're like, pay the rate lock. That is the best rate you'll ever get in your life. Because rates were floating around, between 6 and 7. As we look today, I think I looked yesterday, I could get a loan in my credit union, I think for like 6 or 6.25, but it had 3 points to it, which is ouch. Why do I say that? Well, in single family rentals, if you're looking for cash flow, the interest rate is going to be a burden. And the numbers are not going to work. Just point blank, they're not going to work. Now, if you want to invest and you find an asset that you think is undervalued and a good deal in a great location, and again, that long-term play, 5, 10-year hold. And I just want to be clear on one thing. I'll take us a little sidestep here. We saw this in 2004 to 2007, where people kept jumping real estate. They would buy, and back then they would buy, live in it 6 months and move up to a bigger house because they'd make the money and just keep jumping up. Typically, real estate is not a short-term play. My first house in 2001, I think I lived in it 3 years. It was a 200, I think I paid $220 for it, and I may have sold it for $250. It grew 2 to 3% per year. And by the time you sold it and paid the fees, basically it's like, okay, you break even or made a little bit of money. What people have made over the last few years is not normal. Real estate, if you're thinking about buying real estate as an investment and only holding it for 2 to 3 years and thinking you're going to get that appreciation, I would say don't. My opinion. You can disagree. So on single family, I do think for a good portion in 2025, I don't think you're going to see increases. I think you're going to see more stable, leveling off. Some places I think you'll see some lessening because, to be frank, the salaries can't keep up with the price point. Austin, Texas, great place, beautiful, and pricing has gone, to me, out of control there. And there's just not enough people making enough money to afford all these $1 million homes. And once those start and people dropping those, you're just not going to see. I know other companies are moving to Texas and stuff. That doesn't happen overnight. Everything takes time. So for single family, there's an opportunity. It's strategic. I wouldn't be banking on it for cash flow. I'd be looking at for a long-term appreciation play. And that's what a lot of Class A, good real estate should focus on. I'm in the Washington, D.C. area. We have property from bought it in 2011, 2013, whenever, I forget, but it's over 10 years. And that has, since we bought it, tripled in value. And when we bought it, it actually was pretty much break even on the rent. And now it cash flows several $100s a month, which, also have a 2.75 or 2.5% loan on it too, which is nice. But, the opportunity in single family is there, but just realize long-term play, not short-term. So if someone said, would I invest in single family this year? Yes, I would. Last but not least, talk about what I do. Mortgage notes. What's the one thing mortgage notes have a benefit over all the others is? They are not sensitive to interest rates. And what do I mean by that? I mean, you're the lender. So you're not borrowing money, you are the lender. So I think there's great opportunity in the market this year, as has been last year, for things like seller financing. If you have a property that you could sell and carry the note and you want to try and maybe avoid some taxes, get that person to put the 20% down, sell it to them on seller financing. I am not the biggest seller finance person. Just, to be clear, I'd rather just sell it, get my money and invest it elsewhere. But I'm an active investor. People are more passive. That is an option. Because you could still get, 6, 7, 8% for, that property. If you did some short-term lending, somebody needs, they bought a property and paid cash and they're fixing it up and they need $100,000 to finish it. You could get 10, 11% for 6 months, interest only on that, and be in a first position, borrow with an 800 credit score, and a good position. For us, we invest in non-performing loans, and I am very bullish on non-performing loans coming up this year. It's been at historical lows. When you look at a lot of the data, a lot of the data on traditional real estate, things are flatlining or things are softening. On distressed loans, it's going vertical in a bad way. And we're basically, over the last year, went from all-time lows to back to where we were before COVID. And I think if you ask middle-class America today, are they better off today, post-COVID, than they were pre-COVID? I think a lot of people would say, if you took out the equity that they've got in their house, well, let me phrase that. If they didn't own a home, I think they're going to say no. Or if they bought a home post-COVID, I think they're going to say no. And the reason being is everything is just goddamn expensive. We had to replace a hot water heater. It was 3 times what we paid 10 years ago. Go to the grocery store. Our insurance is skyrocketed. Things have gotten a lot more expensive. And have people seen that in their paycheck? I don't think everyone has. That's why on mortgage notes, on the lending side, in the interest rate environment, is something that is not as much a variable. Now, if you're active and do non-performing, I see considerable opportunity, but let's talk passive. Because I think that's where I really want to get to the audience is, over the next few years, are you looking for an income play or an equity play? That's really what it boils down to. How are your feelings about the economy? If you think it's going to be bullish, go there, a equity play. Invest in multifamily fund. Invest in a office fund. Invest in that type of opportunity. I think it's going to be higher risk, higher reward. 2021, you got awesome returns. 2023, you may have lost everything that you invested in an offering. On the mortgage note side, it's an income play. It's cash flow is what you're looking for. And a lot of people, when things are a little more volatile, go to places that have less volatility. Me personally, just my opinion, I think mortgage notes can be less volatile today than other asset classes. And I think it is a good opportunity because people are moving away from traditional banks to get lending because the banks are a lot more restrictive. And there's more opportunity in that space. You talk to any multifamily developer today, ask them how many deals are underwriting and closing. Talk to a mortgage note guy or woman. We're still seeing over $1 billion a month in loans. There's plenty of inventory for what we're seeing and opportunity out there as well. So when you look at the availability and opportunity within each space, that's something that also has to come into play. So hypothetically, let's review and go back. If I put on my investor hat and I was a risk taker, I would go with investing in commercial office. If I was a non-risk taker, I go mortgage notes. If I was in between, I would go single family rental, but that would be more long term. Then I go multifamily, and last I go short term rentals. And as I mentioned, I'm biased against short term rentals. I love staying at them. I think they're cool to have. As an investment strategy, I think they're better options. And of course, I was going to be biased on mortgage notes. That's what we do. But I tell people today, back in 2022, when we launched our offering and we were competing against those multifamily guys, we were upfront and honest with people that was a great asset class at that time. And if you wanted to diversify mortgage notes, but I would have told you back then, that's where I'd go first. Because rates were 3% and a cap rate at 5%. Meaning that you borrow money to make it. Today, if a cap rate's 5%, interest rate's at 6%, you're negative place. It's costing you more to borrow the money than the money's coming in the door. So you're already running a deficit. Does make sense. I want to just say, hope you enjoyed this episode of the Creating Wealth Simplified podcast. As always, please leave us a review on your favorite listening station. And I'm curious, what are your thoughts? Post in the comments. What are you investing in 2025? Where do you think I was right? Where do you think I was wrong? I want to hear your opinion. So take care, stay healthy, have a happy new year. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.